Welcome back to the Financial Times. I'm in Washington, D.C. today, joined with Gary Gensler, chairman of the Commodity Futures Trading Commission. Recently, the CFTC reached a settlement with Barclays Bank over allegations the bank attempted to manipulate benchmark interest rates. The case resulted in record fines and the resignations of top senior executives at the bank. Mr. Gensler, thanks for joining us.
Good to be with you, Kara.
What does this case say about the culture of global banking?
Well, I think what it says is that this one bank was attempting to manipulate and falsely report a critical rate that matters to all of us. Every American borrows money sometime in their life. It could be a credit card loan, it could be a student loan, a mortgage. And what they might not know in the fine print is the fine print somewhere often says it's based on this rate over in London called the London Interbank Offering Rate, or Libor. And this bank, Barclays, had a pervasive pattern that for profit or reputation that they falsely reported this rate. It's bad. It's serious. It needs to be cleaned up.
What can we take away from this case about global regulation and cooperation? You brought the case with the U.S. Department of Justice and Britain's Financial Services Authority.
It does take a lot of cooperation. I would say this. We need to be well-resourced. I'm sure the FSA probably needs to be well-resourced to bring a case like this. The odds are against regulators because we're so under-resourced.
And the evidence shines a spotlight on the BBA. Would you say that they dropped the ball in their oversight of the Libor rate setting process?
Well, the British Bankers Association is an association. It's a trade association. They're not regulated by, I don't believe, anyone. And I don't think the public should be left at risk of a trade association with the most sophisticated, largest banks setting a rate that's so critical to our credit cards, our student loans, our mortgages. I think there needs to be some real discipline in this, that it's transaction-based, that there's records that are kept, and that the public can rely on something that can't be so readily susceptible to manipulation.
And it sounds like then they didn't do enough when concerns were brought to their attention several years ago.
They could be aware of the same things that we at the CFTC were aware of back in 2008. Reading, many journalists were writing about this. But I think it's now time to fix this benchmark.
Do you see this accelerating any existing financial regulation that's making its way through your agency and others?
Well, we at the CFTC oversee the futures marketplace and, as you said, swaps marketplace, this vast marketplace, which was at the center of the 2008 global crisis. We're over halfway done finalizing the rules. We have about 20 to go. We need to get them done. I think that this case, this Barclays case, and even the recent revelations from J.P. Morgan just remind us about that the banking system needs to have effective oversight, that the banking system is critical to a well-functioning economy, but at the same time you need a well-funded regulator and you need common sense rules of the road. In this case, common sense rules of the road for honesty, that to be fact-based when you're putting together such a rate.
And your settlement was not just financial terms. You mentioned some of these non-financial conditions that Barclays had to undertake, including increased documentation, firewalls between the submitters and the traders, and annual audits by a third party, making sure that they were following these protocols. And there's also an element of having Barclays act as an advocate in discussions with any benchmark setter, whether it's the BBA or someone else. And I wonder, I mean, it seems like this is a little bit of regulation by enforcement.
Well, we're going to use every tool we can, whether it's enforcement tools or rule writing tools, to try to benefit the American public and make sure markets are clean of fraud and manipulation. In this case, this was pervasive. And we worked with Barclays in a cooperative way to come up with these undertakings, yes, to make sure that in the future it's based on the facts of transactions. If they make adjustments, they have to document it and have, as you said, firewalls between the profit-making trading desk and these submitters. We thought this was very critical to this settlement. We hope others take a very close look at it.
I mean, some banks might look at this and say, wow, that's a lot of compliance, that's a lot of new undertakings. Are we going to get swept up in this?
Well, I would suggest to those other banks to make sure that they're submitting things honestly, that it's fact-based, that there are real transactions somewhere, and that people be conscious at the most senior levels that a submitter somewhere might be putting your bank at risk if they're not doing something that's really related to transactions and related to the facts.
Could we see, or will we see, the CFTC look at other similar price-setting mechanisms, whether it's natural gas or somewhere else in the energy markets?
Well, these price reporting agencies, whether they be in the interest rate markets or, as you say, in the energy markets, there's some in the metals markets and agricultural markets, are critical to the markets. We've actually been working at the CFTC internationally through an organization called IOSCO on how price reporting agencies report, and there's very good work done at the international level. But right now we're focused again to ensure that the markets are free of manipulation. And these benchmarks matter. We all lose if the markets aren't reporting accurate information.
Gary Gensler, thank you for joining us.
Thank you very much, Kara.